Property doesn't always beat the stock market. In fact, over the last couple of decades, shares have often performed just as well, if not better. They're also much easier to manage. But for some reason, the rich are buying up more and more property. A new poll shows that 90% of affluent investors plan to increase their allocations to property in 2025. Among family offices, the firms managing billions for the ultra-wealthy, nearly half are set to expand their property portfolios this year. The question is, why? We've spent more than a decade helping clients place over 100 million into property every year, and I've seen the same pattern play out again and again. The wealthiest investors keep increasing their property holdings, even though it hasn't outperformed stocks, because they understand one principle that most people miss that has nothing to do with timing the market or trying to predict the next boom. It's about using property in a way that turns average growth into extraordinary wealth. And it's why 90% of affluent investors are doubling down on UK property in 2025. So in this video, I'll show you the real reason the rich are taking over the market and how you can follow their playbook to build wealth even in flat markets. So why do property investors often end up with more wealth? It's not because the asset class is inherently better. It's because of one key feature that shares don't give you: leverage. With property, you can put in 25% of the money, but get 100% of the gains. As a result, you don't need the asset to massively outperform. You just need it to keep up with inflation. Let me explain. Let's imagine you've bought an investment property for £200,000. You put in £50,000 of your own money as the deposit, and you take out an interest-only mortgage for the remaining £150,000. You don't do anything fancy like renovating it, flipping it, or renting it out to 5 different households. You just hold it. If inflation averages 3% a year for the next decade, after 10 years, your £200,000 property will be worth roughly £268,000. I know this doesn't sound groundbreaking, but here's the part most people miss. Your mortgage hasn't changed. It is still £150,000. So the extra £68,000 in value is all yours, meaning even after we've factored in taxes and costs, you've more than doubled your money. That's the equivalent of more than 7% annual return on your investment, before thinking about the rental income and without property doing anything more than go up roughly in line with inflation. It's not because you timed the market perfectly or chose a property that did better than all its neighbours. It's simply because inflation did what it's supposed to do. Most people see inflation as the enemy. It makes their weekly shop more expensive and it eats away at their cash savings over time. But with property, inflation actually works in your favour. Your debt stands still while your asset rises in value. And the gap between the two is what quietly builds your wealth. You don't need the asset to massively outperform. You just need it to keep up with inflation. That's the beauty of leverage. It turns the unavoidable phenomenon of inflation into real, meaningful wealth growth without you lifting a finger. If you understand that, you see why so many investors love property even in so-called flat markets. Because as long as inflation is doing its slow, predictable work, your wealth is growing quietly behind the scenes. And that is before you've even earned a single pound in rental income. Let's not kid ourselves. No one is getting rich off rental income alone. Maybe you're making a return on your cash of 4 to 7% after all of your costs. It's a decent gain, but it's not exactly life-changing. But let's look closer at the impact that actually has on your income over time. To do that, let's imagine you're renting out a property for £1,200 per month in year 1. If we assume that inflation ticks along at around 3% a year, which is pretty much the average over the last 2 decades, and that rent goes up in line with it, as it usually does, that rent should be around £1,600 a month after 10 years. That's an extra £400 every month without having to do anything special. Of course, your expenses, such as repairs and insurance, will rise gradually too. But if your mortgage rate stays the same, then your mortgage payment won't change. Inflation will push up rents over time, but your biggest monthly cost will stay fixed. So if you fix your mortgage rate for 5 years and you increase the rent every year, your rental return just keeps getting better. Your cash flow improves simply because time and inflation are doing the heavy lifting. This is one of the least talked about advantages of property investing, and it's more true now than it has been for a long time, because your mortgage rate is much less likely to increase than it was during the decade and a half when rates were at historic lows. If the numbers on an investment look good today, they should look even better in 5-10 years' time. So that's why, although inflation might seem like a villain, it can actually be a hero in the property investing world. So if you're starting to see just how powerful leverage and inflation can be, and you want to start applying this strategy for yourself, we've put together a free toolkit that will help. It's based on everything that we've learned from helping investors buy over £100 million worth of property every year. And you can download it for free using the link below. So far, this probably all sounds like a dream strategy. Use leverage, sit tight, and let inflation do its thing. But nothing is ever perfect. So let's look at some of the arguments against taking this approach. Well, I once had someone tell me that they'd never buy an investment property because the mortgage interest was too high. They'd run the numbers and calculated that they'd pay tens of thousands of pounds in interest over the mortgage's 25-year term. It felt like giving money away to the bank, so they decided it just wasn't worth it. But here's what they were missing. If you're making a profit each month after paying your mortgage interest, and you absolutely should be if you're running things properly, then the interest is already taken care of. You're not paying it. Your tenant is. Their rent should cover the mortgage interest, your other expenses, and still leave you with a profit at the end of the month. So while the idea of paying interest for 25 years might sound unappealing, the reality is that you're being paid to hold an appreciating asset. Meanwhile, your equity is growing, your debt is being eroded by inflation, and your rental income is rising over time. If you want to make this work, the key is to run your numbers conservatively. Make sure you've got positive cash flow even after all your expenses. Because once that's locked in, the interest isn't something to fear. It's simply the cost of benefiting from one of the most powerful and inevitable forces in the financial world. And it's a cost that ultimately someone else pays for you. Now, between 2021 and 2023, we saw one of the biggest interest rate shocks in decades. Rates jumped way faster than anyone had anticipated and caught many investors off guard. I talked to so many panic-stricken landlords during this time, worried that their entire plan was about to fall apart. In the end, most landlords adjusted. They cut costs where they could or accepted tighter margins for a while. And crucially, rents rose dramatically at the same time rents did. So while it was a massive and stressful adjustment, it was less painful than it could have been. And so this period proved that yes, rates can go up, but they can only rise so far before they start to break the entire financial system. When rates were at historic lows for 15 years, a correction back to the long-term average was inevitable at some point, even if no one knew for certain when it would happen. And now, it's happened. Interest rates have settled since then, and they're expected to fall further. Of course, they could go the opposite way, but another huge sustained jump is less likely because it would create problems far beyond landlords, not least for the government itself, which has its own debts to service. They have every incentive to keep rates within a manageable range. No, I'm not telling you to ignore the risk. Instead, I'm encouraging you to plan for it. Stress test your deals at higher rates, which lenders will insist on anyway. Look at fixed rate products to lock in certainty for as long as possible, and always leave yourself a margin of safety. And while we're on the topic of control, a lot of new investors think the only way to make money in property is to roll up their sleeves and get their hands dirty. They imagine doing big refurb projects, building a whole extra floor on top of a bungalow, or converting a family home into an HMO to squeeze out every last bit of rent. I've spoken to plenty of people who tell me they wouldn't even consider buying a property unless they could add value with some kind of renovation. There's nothing wrong with that approach because you can absolutely make money through refurbs or multi-lets. But it's easy to forget what it actually involves. It takes time and energy and carries extra risk. You have to manage builders, deal with planning issues, and handle unexpected costs. And even then, the margins that professional developers aim for are often only 10 to 20%. It's not easy money. And so, although it can work, it's not necessary to build wealth through property. Because the entire point of the leverage plus inflation strategy is that it works while you get on with the rest of your life. You don't need to find the next big hotspot, spend your weekends chasing tradespeople, or try and compete with Sarah Beanie. You can let inflation do the work in the background while you focus on your career or business. If you have the skill, interest, or experience to take on projects, great. But if not, there's nothing wrong with keeping it clean and simple. Buy quality properties in good areas, lock in solid financing, and reinvest the profits from your main job. Because sometimes the most powerful strategy isn't the one where you control every single step. It's the one that lets you stay hands-off and consistent, which, as I'm about to explain, can help you avoid a world of trouble when things don't go your way. Now, I've met plenty of investors over the years who are absolutely convinced a property crash was just around the corner. They've been saying it for 10 years or more, waiting for prices to drop so they could swoop in at the bottom. They sat on the sidelines telling themselves it was safer to wait it out. And while they waited, they missed an entire decade of capital growth and consistent rental income. Because the thing about property crashes is they're temporary. Yes, prices can fall and fall fast, but they don't stay down forever. And the losses only become real if you're forced to sell in the middle of the dip. If you can hold on, the market eventually recovers. And as I mentioned earlier, that gap between the rent you charge and the mortgage payment you make widens in your favour. So there's no use waiting around for years trying to catch the absolute bottom. Instead, focus on buying well, making sure the property pays for itself, and holding for the long term. Because if you're cash flow positive, you shouldn't feel pressured to sell, even if prices do dip. You can just sit back, collect the rent, and wait for it all to blow over. That's what keeps you safe through the ups and downs. Now, so far we've focused on how inflation does the heavy lifting in the background. But you don't have to just sit and wait for it. There are other smart ways you can actively boost your returns. We recently worked on a deal in Manchester for some high-quality city centre apartments. They were going for around £300,000 each, which might sound a little steep on the face of it, but they were in a prime location and had really strong tenant demand. And after a lot of back and forth, we managed to get them with a 10% discount from what we knew other buyers were paying in the same building at the same time. That's a £30,000 saving before the buyer even picked up the keys and before inflation worked its magic. This is another big advantage. Unlike the stock market, where the price is the price, with property, it's possible to buy for less than its market value. That doesn't mean it's easy. It's not. And when you dig into it, most times when people think they've got themselves a discount, in fact all they've done is take a little bit off an overinflated asking price. But if you can pull off a genuine discount at the start, you boost your return immediately, without having to rely on the market to do all the work later. That's why experienced investors put so much effort into finding genuine discounts. They work with people who know the area inside out. They look off-market. And they're willing to negotiate hard when appropriate, because a 10% discount up front can be worth years of inflation. But this isn't the only way to set yourself up for an impressive profit before even picking up your keys. To really hit the ground running, you'll need to be proactive from the moment you start your property search. Because a lot of people look at national house price averages and assume that tells the whole story. They see a single headline figure and think prices must be moving the same way everywhere. But property markets are local, and the differences between regions can be massive. Over the next 5 years, total capital growth in the Northwest is projected to be almost double that of London. That's according to the latest house price forecasts from Savills. And this disparity between different locations can make a huge difference. You don't need to find the next hidden gem or the secret hotspots no one else knows about. You just need to avoid the obvious duds. To do that, focus on regions and cities with strong fundamentals, the places with jobs, population growth, major infrastructure investment, and consistent rental demand. These factors aren't glamorous, but they're usually reliable. That's why experienced investors start by picking the right region before they do anything else. Because the UK average hides a lot of variation underneath. And even a 2% difference in growth rates each year can turn into life-changing results over the long term. This is especially true if you have a number of investments in your portfolio, because once you've got 3, 4, 5 or more properties, it becomes easier to take advantage of this third and final tailwind. To really illustrate this strategy, I need to tell you about an investor who started out with plain, straightforward buy-to-lets. Nothing fancy, just good areas, reliable tenants and solid management. For the first few years, he kept it simple on purpose. He wanted to make sure that the numbers worked and that he understood what he was doing before taking on anything that required too much of his time. Then, once he had a few properties under his belt and some equity built up, he decided to try a small refurb project. Then, another one after that. A lot of people assume that if you're taking a passive approach like this investor did in the beginning, you're giving up all the upside. But you're not locking yourself out of anything. You can always choose to layer on flips, refurbs, planning gain, or multi-lets further down the line. None of that is required to make the basic strategy work, but it gives you options once you're comfortable. That's why the smartest move is to build a solid, reliable base first. Start on easy mode, build up your knowledge of the basics, and rack up some wins. Then, with that experience, plus the rental income putting you in a stronger financial position, you can decide if you want to stack more strategies on top. Now, of course, the market is always changing. Rates shift, new hotspots emerge, and the rules around investing never stand still. So if you want to stay ahead of the curve, we've created a free weekly email. It's where we share the latest news, insights, and opportunities that we're seeing in real time before it hits YouTube. You can sign up right now using the link in the description. So now you know why the rich are buying more and more property. But knowing why they do it is only half the story. The real edge comes from knowing what to buy. So watch this video next, where I'll show you how to find better property deals than 99% of investors, so you can apply the same strategies the wealthy use to your own portfolio.